All right, so this particular module, the problems become a little bit more unfamiliar from what you've experienced in intro. And as I mentioned in my video lectures, that there's not a whole lot of income statement emphasis in intro. So you're going to start seeing more problems videos from this point in the course on out. Um, they just don't, they didn't feel as necessary for the first few modules, but now it starts to get a little bit less certain. So I'm not going to go through all of case one. I do want to kind of set up the idea about what's going on. So when you have a multi-step income statement, as we talked about in the lecture videos, um, the different expenses and revenues fall into different buckets depending on whether they're operating expenses, non-operating items, or they fall below the line. The below the line designation means below tax expense. So there's only one item so far that we've talked about that falls below tax expense, and those are the items that have to do with discontinued operations. Operating expenses comprise the operating activities of the company. Non-operating items tend to revolve around investing and financing activities, which means the company is either investing in bonds and stocks of other companies, and there are revenues or expenses associated with those investment holdings, or they are perhaps a very unusual or infrequent item. That's typically what comprises non-operating expenses and non-operating revenues or non-operating losses and gains. Below the line, as I said, there's really only one item. And so far that we've talked about, and that's discontinued ops. The pre or net of tax, this is about how is that particular account disclosed on the income statement. So all of the expenses, revenues, gains and losses in the T account, in the T accounts are going to be pre-tax amounts. But when we go to present them on a financial statement, we may modify that to a net of tax amount. We might need to take out taxes. And in terms of what is net of tax, well, the only thing that we present net of tax are those items that fall below tax expense. I'm going to grab here on my desk, the template of the income statement. Just to go back through, this was something I covered in my lecture video. And of course, we have our operating items up here, including net sales COGS, and all of this here. Then we have our non-operating items. This is my investing and financing activities. Notice then all of these are at pre-tax amounts. All of these amounts would be pre-tax. We would get a pre-tax on everything, the summation of all the revenues and the expenses added or combined together, and that would give me income before income taxes. That's when I tax them all at the same time. I take this pre-tax amount, I get a tax expense from all those pre-tax amounts, and then this would be the net of tax amount of this amount right here, right? Because this would be the full amount. I net off, say, 20%. This would be 80% of this full amount that's remaining. Below that, and as discussed in the videos with discontinued operations, I have to net tax separately. Why? Because those tax effects were not considered here. So we back taxes out separately because they were not backed out with this tax expense. This is called intra-period tax allocation. So I net tax out, I put the tax amount here, the 20%, and then these two numbers here would be the net of tax amounts. So that's what the whole pre-tax net of tax means. And basically what this exercise boils down to is giving you a list of items and where they would fall on a multi-step income statement. This is really good to start developing a list of items. Now, there are not many items that do not fall in operating items. There's just a few. So find them, look through them, do this exercise. It'll help you with classification. Now, this case number 2 and 3 are a little bit more difficult. Um, Both of them have you prepare a discontinued operations disclosure. And I would say of the two, case number 3 has more components to it. So I'm going to do case number 3, and then you can figure out case number 2 from that, perhaps apply it all. I don't want to let you kind of off the hook and doing all the work for your behalf. But you do have a key, so it'll help you sort through the pieces that you might be missing. The reason why I think case number 3 is a little bit different is just simply because in case number 2, I have, in case number 2, I give you certain items that you have to figure out and actually combine some information here for. For example, in case number 2, I tell you what the book value of the discontinued components net assets were, or I tell you what the fair value of the net assets would be. So, and I also give you the operating loss of the discontinued component. So those things are given to you. Here, you actually have to calculate them, understanding what the idea of net assets are. So in this particular case, we got a company, Prop and Lock. They decided during the fiscal year 20X6 to discontinue some of its operations. It met the qualifications of a discontinued op. It was a strategic shift. We can separate the cash flows from the ongoing operations of the company. And they have the following items. They tell me about the book value of assets, the fair value of assets. This is all about the discontinued operations, not the entire company, but just that one segment that the company is going to discontinue. The book value of liabilities, the fair value of liabilities, revenues and expenses, and then the estimated costs to dispose and sell the company. So with that information, it starts you off with, okay, here's the income from continuing operations for the company. So where we are being started here is right down here, right? The income from continuing operations of the company. Right. And why is that the income from continuing operations? Well, because it includes all the effects and only the effects of the continuing operations up to this point. And then after that, it brings in the discontinued operations. So if we start the disclosure with that income from continuing operations, and we also want to be very cognizant of whether this income from continuing operations is net of tax or not. And in this case, it says, yes, they had after-tax income from continuing operations. So we don't have to do anything else with that particular piece. So this tax expense here has already been, we already deducted an amount of tax expense from this item, and we have $1,745,000 remaining. This is a 40% tax rate. All right. So this is what's remaining. This is 60% of the full amount, since we just deducted an amount that was 40%. And now we can figure out what's going on after that. We are looking to fill out the rest of this for the year 20X6. And remember that the first thing we got to understand is if they did not, if they were unable to sell the discontinued division, right? We decided to discontinue in 20X6, but we decided, we could not actually find a buyer. We couldn't get the deal settled during 20X6. Well, in that case, we have to check for impairment. An impairment of an asset that we are trying to sell. Now, we are trying to sell a lot of assets and liabilities with a discontinued op, right? We got book value of assets for this discontinued op. We have the book value of liabilities for this discontinued op. So it's more than one asset and more than one liability that we're talking about. But when we're holding something for sale, the decision for impairment is so to determine whether impairment is necessary, what we're going to look at is the book value of net assets. And we're going to compare that against the fair value of net assets less cost to sell. So we want to take the whole quantity, right, of the fair value of net assets less the cost to sell. So net assets are assets less liabilities. And we're going to look at this particular company's portfolio of assets and liabilities. They had $2,375,000 of assets, book value, and their liabilities had a book value of $1,950,000. And we take the difference between those two, and that looks like it should be $425,000. So that's the book value of net assets after I solve it. I'm doing math mentally, which is an occupational hazard sometimes, but it looks like that's right. I'll grab my phone just to verify future numbers. Now we have the fair value of net assets. The fair value of net assets is the same idea. We're just now taking the fair value amounts. So we want to take 1,785,000 and we're going to take 1,482,000. That's the liabilities. So the difference between 1,785,000 and 1,482,000 is 303 million, but we also need to subtract off the cost to sell. So we take that and then we also bring in those costs to sell, $75,000. So that comes out to $228,000. All right. So now we determine, is impairment necessary? Well, is impairment necessary? It relies on whether book value overstates or understates this amount. So if the book value of net assets is less than the fair value of net assets, then that means that we're okay. Because what we do not want to happen is that book value overstates what I could eventually sell this for. So since book value is greater than the amount of fair value of net assets less the cost to sell, this means that we have to apply impairment. And we're going to apply impairment for the difference because all we're trying to do is bring the book value down to this value here. So we take the difference between 425 and 228, and that gives me $197,000. of pre-tax impairment loss. Now let's talk a little bit, about don't just ever try to memorize something. You're not that good at it, I can tell you, if you're an average person. You will start to mistake what to subtract from which, especially when we bring in selling the discontinued component. So really give a thought to what's going on around this. Remember, book value and fair value are not likely to be equal. If they are, it's just a crazy coincidence, okay? Because book value is what is on the balance sheet. And remember from the balance sheet material that many of the assets we hold are not held at fair value. They are held by subtracting accumulated depreciation or subtracting accumulated amortization or the lower of cost or net realizable value or lots of different ways of valuing items on the balance sheet versus fair value is strictly what could I get for selling the asset. Now, what this is intending to do, why we have to check for impairment when we haven't sold the item, is we're trying to sell these net assets. And if we're going to sell them, we can only sell them for their fair value. Normally, we wouldn't worry about marking them down to fair value, but now we have a reason to do that in an accounting context because we're trying to sell them. So what makes more sense than portraying the value of something I'm trying to sell than putting it at the value that I think I could sell it for, right? The book value is not the value I think I can sell these for. So if that book value is that we have is overstating what I ultimately am estimating I will get from the sale, then we want to bring it down to the sale value. This is an invocation of the conservatism principle, okay, of conservatism in general, which the FASB says is not a concept, but we still do a lot anyway. The other thing is we want to subtract these costs to sell because if you think about trying to sell something, all right, you might estimate that, yeah, I could, what the sell price of what I have here is $1,785,000, $1,785,000 assets, right? I could sell all my assets for that amount. But is that really what I'm going to realize from the sell? Well, it's not if I have cost to sell. And cost to sell can be a lot of things. It could, think about commissions, think about closing costs, think about title, and lots of different items that factor in taxes, items like that factor in when you're selling large scale assets. And in this case, also liabilities. So, understanding what you're doing is so important in accounting because otherwise you're just manipulating numbers and just no easy way to remember how to manipulate them and you won't be able to memorize them. I've had many people try and few ever succeed very much so. So, this is a pre-tax impairment. And remember, we are below the tax expense line. So that tax expense that I assessed here is not going to include any tax here because that was not a part of the items above the line. And so when I go to write out this impairment loss, I specify that it's net of tax. And I can even give you the amount of tax that it's net of. So it's net of tax 197. In this problem, the tax rate is 40%. So I take 40% of 197,000, and that is 78.8. This would be my tax effect. Now, impairments are always losses. In this case, a tax effect is actually going to reduce the loss. So we take 197, which is our total loss, subtract out the amount of taxes that we save on that loss, and I get 118,200. So that's the tax effect. This is the net of tax amount. Another way that you can think of this, and I think is perhaps a little bit more useful to some, is if 197,000 is the full amount, then what I'm really doing is just separating this out into 40% and 60%. And 40% of 197 we already have is 78.8. And if I'm just breaking this off into two pieces, then the only amount that's left of 197 after I take out that much is the 118,200. And so that kind of gives you maybe a better clue. I don't know if taxes, again, seem to not jive well with people. Not sure why, but whatever helps you figure this out, use it, right? Net of tax, the net of tax amount is 78.8. So that's my tax effect. It's actually a tax savings. That's why I call it an effect and not like a tax expense. Then after I take those taxes out, I have $118,200 still of a loss, right? It's still a loss on impairment. All right, so we got the impairment piece done. The next piece would be, well, was there revenue or expense from the operating activities of the company, of the discontinued component of the company? And remember that even though we're discontinuing, that doesn't mean we shutter it down, that it's not doing anything. This portion of the company is still very much active. So it will record revenue from its operations, it will record expenses, and these are the amounts that I give you for those two pieces. So that's 132,500, 1,325,000, and 1,135,000. And I take the difference between those two to give me the amount of net income from the discontinued op. So, and actually I say net income, but this is the income before taxes. When I say net income, that tends to mean it's net of tax. So this is the income before taxes of the disc op. It's our pre-tax. We take the 190 and then we multiply it by 0.4. I'm just going to do this version where I just strip it into two pieces. The tax effect of that 190 is 76,000. And what's remaining at that point would be 114,000. So that's the net of tax amount. Remember, what I want to then show is I have income, because it is positive, right? The revenues were larger than expenses. Income from disc ops, net of tax, and the tax that it's net of is 76,000. And the amount that's remaining is positive. It's the 114. And then I can combine those two things together, 1,745 less 118.2 plus 114. And that gives me 1,740,800. And that is net income. Okay, so this is what that final piece of the income statement would look like for 20x6. Like, I don't give you enough information to derive everything above that, You can figure out tax expense and you can figure out the pre-tax income, but after that, you have no information about any of the continuing operation individual expenses and revenues. But overall, then this is the work and the amounts that you would find in this particular section of the discontinued op. Now, moving on to part B. It doesn't ask us to prepare a disclosure, so I don't have to go through any of this. And all it's asking for is what would the gain or loss on disposal be? Assume a 40% tax rate. So now we are in this next year, right? So you got to be careful. Like, there's no way it could have been in this 20x6 year because I wouldn't have had to check for impairment if I had sold it, because the sale is basically a reality check of impairment, right? In 20x6, I'm kind of acting as if, oh, if I were to sell it this year, this would be the amount of loss that I would experience from the sale. But now that we're actually selling it in 20x7, there is no check for impairment. We just calculate a gain or loss on disposal. So for part B, the company, the discontinued division, even though it was sold in March, would still have had likely some revenues and expenses in 20x7. But we're not given any information on that. Again, we're not asked for the full disclosure, but we are asked for that sale. So when we're calculating a gain or loss on sale, what I always encourage people to consider is what I got and what I gave up. And in this case, really what we're talking about is what is the book value of what I got and what is the book value of what I gave up. Because a gain or a loss is all about the inequality that occurs when assets are brought onto the balance sheet and assets are taken off of the balance sheet. It could be the inequality when liabilities are brought onto the balance sheet and liabilities are taken off of the balance sheet. Okay, but it's just basically we're exchanging two values. There's a value coming onto the balance sheet and there's a value leaving the balance sheet. And if those two aren't equal, then we have to have something that explains that differential in order to keep the equality of assets, liabilities, and equities. So what did I get in this case? In this case, I got, according to the problem, $275,000, and I spent $75,000 cash settling the disposal costs. So I got 275,000. And since it's cash, the book value of cash is simply the amount of cash I got. And so that's what I got. Now, what did I give up? Well, I gave up, in this case, a discontinued operation. And when we are giving up a segment of a business or an entire business, the way that we assess the book value of a business is its net assets. So we're talking about giving up the book value of the net assets of the disc op. And I also had to give up some disposal cost cash. Like, I actually had to pay that cash. So I gave up really two things to get this one item. The disposal cost, it said, were 75,000. Now, what was the book value of what I gave up? This is where you have to be a little careful, because the book value of what I gave up prior to impairment was $2,375,000. But after impairment, after I reduced its value by 197,000, um, uh, I'm sorry, yeah, after I reduced its book value by 197,000, it became 228,000. This is my new book value after impairment. So I take that amount And because I gave up not just those net assets, but also $75,000, I have to think about them both when I'm considering what I got versus what I gave up. Now, in terms of recording a gain or a loss, if what I got exceeds what I gave up, then that's a gain. But if what I gave up exceeds what I got, then that's a loss. Like I got less value than I gave up. So in this case, 228 plus 75, that's 303,000. And we compare that against the $275,000 of cash that I got. Well, in this case, I got less than I gave up, and that implies a loss of, in this case, $28,000. And that's a pre-tax loss. So if we were going to go for the net tax amount, right, then we have to strip away 40% of the taxes. The tax effect of the 28,000 would be 11,200. And that is taxes I do not have to pay because I am basically shielding some income with this loss. And so what's remaining of that amount of 28,000 is 16,800. This would be my, and then in parentheses, because it is a loss, net of tax. Oops. Loss. Right. So very important to remember in this particular problem, or when you're thinking about the sale and the gain or loss on the sale of our discontinued component, is understand that when we impair, there's a new book value, and the new book value is the amount that I impaired it down to, the 228 in this case. You also have to remember that if there are confirmed costs to sell, that those add in to calculating what I gave up. Right? This cash amount is what I got. And then all we're doing with a gain or a loss on a sell is making up for the differential between the amount that I got, in this case, the 275 of cash, and the amount of assets I had to give up, which were net assets of 228 and cash of 75,000 for the disposal.